So today, our panel is going to consist of Jennifer and I, and we're going to talk to you a little bit about the lending and insurance industry. And I thought we'd start by kind of having a brief conversation about what's happened in the industry, especially since January of 2020. I know some of the things that have affected your business, Jennifer, actually started happening before 2020, but for my business, it really was impacted in 2020. So just to kind of recap and take a look back, when we started January of 2020, rates were low and they were getting lower. We were already seeing a refinance boom, economy was great, and inventory was short. So that's where the lending industry was at that time. In insurance?
Insurance, well, in the early 2020, we still had a lot of companies still writing business. They started to get a little tougher on roofs and storms and water. And then as the year progressed, not really to do with COVID, just because the market, a lot of things have changed. And as we see now today, we've gone from being able to easily insure a home that has a 20-year-old roof to now the insurance companies are looking at 5 and 10-year-old roofs. So it's really important to, go ahead and find your insurance as soon as you, get an offer accepted or accept an offer. To make sure the closing goes as it should. And the good thing about our industry, it also made us go a little bit more virtual. So now we can literally work from anywhere at any time. I answer my phone on the weekends, in the evening. I've always got my computer at my side, so I'm always up to date and ready to do what I need to do.
Well, that's kind of a look back at where we were in January. I wanted to talk real brief too about the effects of the actual quarantine, because I really saw it in lending. It almost instantly created a total change in mortgage guidelines. Within a matter of minutes, almost overnight, certain programs were gone completely. Credit scores went up by 40 points as far as what was the minimum and what was necessary. And it really became a total change. The non-QM market was gone. We really had to readdress every single borrower to make sure they still qualified. So, that meant things were tightening up, programs were gone, and it was tougher to sell the loans in the secondary market. So that created a lot of really strange changes. Did you have anything like that in your business?
Well, actually we did. When you talk about credit scores, a lot of people really don't understand, but insurance also looks at your credit score and looks at your insurance score. So, that is a big part of what drives your rate also. So, also with lending as with insurance, you want to make sure that you can, have the best credit score that you can to get your best rates, whether it's insurance or mortgage.
So to kind of look at where we're at today now, the interesting thing is, as most of you know, a large percentage of the workers were able to work from home. And with my industry, it didn't affect it too much because we already allowed people a flexible schedule to work from home when they needed to anyway. So it wasn't too traumatic from that change. But what you saw nationwide was a real change in attitudes of people, especially when you think about the fact we were quarantined, started in March, April. It's still pretty cold up north during that time. When they went to working remotely and then employers said, you know what, this kind of works for us. Does it work for you? And the employees say, yeah. And so suddenly the attitude changed and we saw a bunch of people go, well, wait a minute. If I can work from anywhere, why not move to Florida? It's so much nicer here. So that kind of started what I like to think of as the panic that started in the inventory and housing industry, where people started to kind of get pent up demand for moving. Part of that was because they could work from anywhere, and part of that was just because we were confined to our homes, and some of us said, we don't necessarily like this place. We want to move. So I don't know if you have anything like that you see today that's changed, Jennifer?
Well, not really on the homeowner side, but just a little tip. If you have auto insurance and you're now working from home, you can call your agent and maybe get your auto rates reduced a little bit because now your car isn't used to go back and forth to work every day. Just a little tip that somebody, may be able to use and save them some money.
Well, those are some of the things that have changed. Of course, we know how this whole Zoom has changed a lot of things. We're now able to do things like we're doing here, where we've got people in person with us and we have people visiting with us online. So that's kind of strengthened what we can do and added to what we can do. The tougher things, though, from the lending side of it has more to do with guideline changes. There's not just the credit scores, but with this mass panic of purchasing, and especially in some of the hot markets, what we've seen is the lenders have gotten extremely tight with what they considered non-owner occupied properties, which is now anything that isn't your primary residence. Second homes, investment properties, all of those things have gotten much tighter guidelines. What that means for me is that it takes a lot more time for me to qualify the borrower. I have to go back and double check guidelines. Some things have changed for them, some have not. Rates have added little ticks to what they increase. They'll increase the rate a little bit if your credit score's low. Oh, now it's a non-owner occupied, now it's a condo. So there's all these little things that they've been adding to the rates little by little to increase them even though they're low. Now, saying that, I think the highest one I did was at 3.875. That's not high. So even though the changes have been there, they're not anything that's going to squelch anyone from buying. It's just the concepts and what's happening out there is a little, sorry. I thought that was on mute. Yeah, I'm gonna sing and dance. The other thing that's out there in my industry is reserves. Cash reserves have become critical. And in a day and age where you're seeing people paying over appraised value, that's some of the things I really have to take a look at, because people are using a lot of cash to buy the property more so than they were before. And they're forgetting about the fact that you still need some reserves. So that's some of the things that have happened. More compliance guidelines due to COVID-19, the forbearance that's been allowed, the rental moratorium. These are all things that have kind of come back, and they're affecting the qualification ability of people when it comes to mortgages. The other thing that's making my job a little stressful is that it's taking longer to get all this done, and yet sellers are being so demanding they want a shorter time frame to close. So, and then of course we all know that cash offers are certainly pushing up prices and they're not necessarily appraising. So those are some of the challenges. We'll come back to solutions, but I want Jennifer to talk a little about insurance and what's happening with those challenges.
Well, as y'all probably know, if you've gotten your homeowner's bill, that the rates are going up. There's nothing wrong with shopping your rates to make sure that, you know, you're where you need to be. But also with the shorter closing, there's a shorter amount of time to get things done. So my suggestion is as soon as your offer is accepted or you accept an offer, go out and start working on your insurance, get those inspections done. Because I've seen, you know, like 5-day inspection, and you know, these have to be taken care of if there's anything wrong, because insurance, again, just like the mortgage company, has really tightened their guidelines. We have companies that won't do a roof over 5 years old. A lot of them won't do a roof over 10 years old. A lot of companies, now we're going into hurricane season, has said, you know what, we're going to stop writing any business in these zip codes. It's very, very rarely that we have companies that say we don't want any more business. But I'm going to be honest with you right now, there's a lot of companies out there that don't. On the flip side of that, we do have alternates that we can do. And even if we have to place somebody someplace, you know, until things calm down, we have the ability to do that. But there's just a lot of restrictions and a lot of underwriting. So it takes time to get the insurance in place. So, you know, along with your mortgage broker and your insurance, you kind of want your real estate, everybody should work together to get that closed, because we all have the same ultimate goal: get that person in that house, their dream house, without any problems, just as smooth as we can do it.
So we've talked about a couple of the solutions. Let's talk about a couple more. What can you do to keep things going smoothly and have things close on time and keep your life in some kind of sanity? I'm going to start by saying, don't buy into the hype. Don't go there. So many people now are pushing so hard to do something so quickly, so fast, that they are making very irrational decisions, and they kind of want to pull all of us down with them. This is what we want to do. Come on, jump in with me. It doesn't necessarily make sense. And I know our financial architect is here. He can tell you how upset he gets when he hears someone say, oh, I just pulled money out of my IRA to pay cash for a property so that I can get a house.
That makes sense.
I will tell you, I got a call last week from someone that did that. And her financial planner said, you can't do that. That you're destroying your money. You're going to have to pay taxes on your IRA. So she's calling me in a panic, and I'm saying, I am so sorry, but you are self-employed. You have multiple properties. I cannot give you a determination in 5 minutes. Here's all the things you have to do to get me the information I need to figure out if you qualify. Long and short of it was, she ended up deciding on the advice of her financial planner that she probably could not get financing right now, and we'd be better off just buying the property and flipping it. So now you're gambling, A, on your IRA, and B, on the fact that you're going to be able to fix the property up and flip it in a really short period of time to not pay the penalty. So that's just one example of the hype that people are trying to get all of us to buy into.
But you can't finance those, right?
Well, the problem, and this is the other thing, the problem that
This question, they didn't hear it.
no, Stephen asked the question, whether or not you can finance those. Here's the problem. You're talking about a non-owner occupied purchase. So we already have different guidelines with that. They do not have rental history. There are other properties that they own or vacant land. So you've got a multiple group of situations that are a problem there. And the other problem that comes up is so many people are doing this figuring that they are going to get their cash back right after closing. And this industry has come up with guidelines across the board on how many people, how many lenders can lend to non-owner occupied properties. And that figure is 7%. That's a pretty low number in a state like Florida when you have so many second homes and so many investor properties. So a lot of times these people are finding that they are not able to pull their cash out right away. And they are shocked by that. They go into this thinking it's going to be an easy, quick fix. So what do you do as the agent? Ask your customer. If you're paying cash, is this a transaction where you're thinking you're going to need your cash back right away? Or are you solvent enough that you can pay cash for this and not worry about keeping the money tied up in that house for a while? And I mention that because we've talked about a lot of the sales that have fallen through recently. And one of the things I'm seeing is that's why they're pulling their money out of sources or thinking they'll pull their money out of sources and finding out that it will cost them a lot more than they thought to do that. And so during the inspection time frame, they're just canceling the contract. So any other tips that you want to add, Jennifer?
Yeah, and going back to qualifying for a mortgage, now that insurance rates have gone up so high, sometimes the DTI, because of the insurance, puts people over, you know, where they need to be. And so we have to do some finagling, and you don't want to short your homeowner's insurance because that's, you know, your biggest purchase here. And now you're saying, well, I just need this number. You don't ever want to put yourself in that position. So you want to make sure that, you know, you're buying properties or your customers are buying properties they can actually afford. Also, in insurance, when we insure a home, we don't insure the land. We don't insure what you buy it. We don't insure your mortgage. We insure the rebuilding of that home. So if you are really overpaying for that home, we can still only insure it up to the replacement value. So, you know, think about all these things when you're looking at a property or your customer's looking at a property to make this, you know, offer on it. It's all things considered. The ducks have to fall in the row to make it happen.
Jennifer made a very good point. The debt to income ratio, the housing ratio with the higher insurance costs, those are some things that can really throw people out of the qualifying market. And I love the fact that I can work with you, Jennifer, because I did have that situation come up on one where I could get them into a really nice program with a better interest rate, but the qualifying ratio was so tight, I had to come to you and say, What can we do to get these people insured properly, but yet still get them qualified for that great interest rate? So we're having to look creatively on how to structure loans in the first place, and doing it up front is certainly much easier than trying to do it down the road. So one of the other things I'll mention real quick is the appraisals. Obviously, we know that can be an issue. And what I'm asking a lot of agents to do when somebody's writing an offer is to give me an idea if they know what they think the value is going to come in at. Because there may be ways for me to look at, sorry, that's me. Jeez.
Lenders.
Busy.
Yeah, busy. Now I lost my train of thought.
What's my rate today? That's what they're all about.
They're calling about how quick can we close.
Yeah.
Yeah. So the debt to income ratio is one of the things that really can throw me off. And I will actually reach out to Jennifer sometimes when I know I'm close on that and say, I know I don't have any inspections on this yet, but can you give me a general idea where you think the insurance premium is going to come in at? It really helps me. So we've discussed the fact that having your team is so crucial. The people that you know you can call and say, okay, Jennifer, I know I'm going to have an issue. Can you help? Can you tell me what to look for on your side of things? How's that going to affect everything?
Yep. And flood insurance is also a thing that can throw you off.
Oh, big time. Yeah.
Big time.
That's
Yep.
the one I'm normally calling you about.
Yep. But that's, again, like she said, when you have a team, we're all in it for the same thing. We're all in it to get, the people in their house. And we're all committed to that.
That one of the things I like the best is when I actually get to work with a borrower and their financial planner, because that to me is the perfect scenario of that match.
Absolutely.
Because just like we match the property, the insurance, the financing, this is matching the customer's overall goal for what they want to do with their finances, and the house is just one part of that. So that's why I really enjoy when I get a financial planner involved, when we can just say, okay, this is how we're going to work everything so that the customer still achieves their ultimate goal.
Absolutely. And that goes back to inspectors too. Home inspectors are a very important part of this. And a lot of times I call Jay and go, hey, Jay, what is going up with this? And he can explain it to me, where I can explain it to an underwriter or to a customer. You need to have that rapport with that inspector, because we'll tell you what, we see some horrible reports that make absolutely no sense, and we can't get a hold of the inspector. They can't explain it. It's nice to be able to have Jay here on my speed dial and say, hey, Jay, what's up with this house? So it's always important to have your team.
So we kind of covered a lot here, from everything from where we were in January 2020 to what's happening and where we're at now, and some ideas on how you can kind of maneuver with the changes going on. Do we have any general questions from anybody? Anyone on the chat? Anyone here live in person that has any general questions?
I have one, so you'll have to relay.
Okay.
Okay.
In regards to the cash to close, when with inflated prices the way they are and buyers just able to make the sale, is there anything that can be done on the insurance end to make the insurance side more affordable, and then they can redo their insurance after their purchase? Is the market like that?
Yeah, there's things we can do. It depends. Every case is different. It depends on what the customer can handle and what, is their outcome is. But, we do work with people to make sure that things get right. We do not, undercut coverages. We don't do any of that, but there might be some parts of the insurance that, maybe you don't want replacement costs on your contents right now. That's a couple $100 on your policy, and maybe you add it back in after you close. So we don't do anything that would hurt the insurance, that would make you, vulnerable. Absolutely not. And, but there are things that, you can choose a higher deductible and things like that. So there are things that we can work with.
Good to know.
Well, one of the other things I want to mention real quick, because Jennifer, you've done this for some of my customers before, where you've been able to look at the report and see that if they do a couple of little things after closing, that's something that can increase their discounts. so that they
Absolutely.
get better insurance coverage.
Absolutely. And, you know, and sometimes we have to write a policy, a home in one company. And once these things are fixed, we can put them in a standard market that has better rates. So, you know, just know that your homeowner's insurance, just because it's an annual thing, it does, you know, we can cancel it and rewrite it when things qualify differently. A roof is a big thing. Is if you replace your roof right after closing, Jay comes out and does a wind mitigation, that could save you $1,000 on your insurance right there. So
Boom.
yeah, there's a lot of things you can do.
Kendall.
Jump one in there.
Come on, Kendall.
All right. So Diana was talking earlier about people pulling money out of their IRAs to, finance a home or to help. I know when I went through the process, one of the things was, where are you getting that money from? So speak to how that negatively impacts with the lender's point of view. If someone's pulling money out of an IRA as a lender, aren't you already going, wait a second, if they're having to do this, can they really afford the house?
That's actually a very interesting question, because I'll give you an example of a loan I've got going on right now. The person is paying so much over appraised value, which she knew she was doing that when she purchased, that I'm looking now at maximum financing. So I'm looking at a 97% loan to value with somebody who's coming up with $25,000 down. But from an underwriting guideline, they are tracking that money like you would not believe. They want to see every step of the way that it's not just coming out of the account, or that they've got the money in their IRA account, but they want to track it coming out of the account and then show the statement afterwards. So it's affecting them from that perspective. If you go back to the real estate bust time, you will see that that's where the biggest fraud was going on, with money moving around too fluidly, and that's what they call money laundering. So when people ask me, why do I have to look at all of this and document it? Can you say drug cartels? So they do look at things like that. And I have to say, that's the other reason I the options that they may have. Other times, the accountant or the financial planner may say, let's see if there's another option. So I had one guy that wanted to come to me for financing, and I told him to talk to his financial planner because he had enough assets that he could have gotten, in my opinion, a better option by getting a loan against his assets. So that's where it comes into play, that a lot of those things before, they are looking at differently now as far as where the money is coming from, how they're using it, and what is left over.
I would imagine too that depleting your assets is going to hurt when you go in for a loan and you don't have anything to back you up but property. So.
Yep. That's that reserves thing again. They love to see that you have a minimum of 3 months of house payments. Any financial planner will tell you, you need to have a minimum of at least 6 months of total expenses. And a lot of times you are draining most of your assets just to buy that house. So it's one of those things where we really have to slow people down a little bit and say, stop and think. We don't want to put you into a house that you immediately lose. So we're having to step back a bit and calming people down from this total panic that they're under right now.